But I can tell you, if you own gold, you are going to have an official, call it a tailwind, because governments all over the world are wanting to revalue gold higher in order to create more liquidity and ease the debt situation. But understand, for years and years, forever up until now, the U.S. Treasury / Federal Reserve never wanted the price of gold to go higher because it's a direct competitor with the U.S. dollar. And I mean, if you look, just go back, 5 or 6 years, gold was $1,300 in 2019. It's more than doubled. And the price of gold more than doubling tells you that the value, the purchasing power of your dollar has dropped more than 50% in 6 years.
Revaluing gold is not a signal of strength. It is a signal that other options have failed. The deeper issue here is trust. Trust in public finance. Trust in fiat currency. Trust that debt can still be managed within the bounds of reason and discipline. When that trust weakens, gold returns to the fore. The U.S. dollar's weakening grip on global reserves, exacerbated by central banks' 900-ton gold purchase spree in 2025, further underscores the need to view gold through a dual lens, as both an inflationary shield and a geopolitical hedge. For decades, Washington worked to suppress gold prices to protect the dollar. With mounting debt and talk of revaluing gold to boost liquidity, governments worldwide may be ready to push it higher. Precious metals expert Bill Holter points to a harsh lesson from Weimar Germany, where the currency suffered a catastrophic collapse. Fast forward to today, there's open talk of revaluing gold to pump liquidity into the system. The U.S. holds 262 million ounces of gold. Holter math says it would need to hit about $125,000 an ounce to cover the $36 trillion debt. Fed released a report analyzing how countries leveraged gold revaluation gains to raise capital without issuing debt. Revaluing the gold could unlock hundreds of billions without any actual transaction of the metal itself. According to the August 1st Fed research note, governments in other countries have used revaluation gains to pay down debt or cover central bank losses. More than half the world is already ditching the U.S. dollar and treasuries. That's the reset in motion. Bill Holter's point is simple. A bankrupt government issues the world's reserve currency, and the entire system sits on that shaky foundation. The great inflation and worsening fiscal outlook have shaken faith in U.S. economic strength. Trump's abrupt tariff rollout and reversal in April triggered a rare drop in both the dollar and treasuries, with the dollar index plunging over 10%, its worst first half since 1973. Before we dive into Bill Holter's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Obviously, there was a financial reset in 1944, Bretton Woods, another reset in 1971 when we went off the gold standard. I guess, and this is the way, when I talk to people regarding the current situation, my first question is the U.S. government bankrupt? Are they broke? And 95% of the people will say, well, of course they are, but it doesn't matter. Yep. And then my next question would be, who is the issuer of the world's reserve currency? It's the same entity. So you have a financial world that's running on top of a foundation of paper treasuries that are issued by a bankrupt entity. So the absolute need for a financial reset is in place, and there would be no BRICS if that was not the case. More than half the world now has begun the process of moving away from dollars, moving away from U.S. treasuries as the foundation for the world's financial system. There's your reset right there. The world is resetting away from the United States. In Weimar Germany, when the currency went away, what did they do? The banks rewrote all of the debt in grams of gold. So either you had gold or you weren't able to pay your debt. And if you couldn't pay your debt, you're out of business. The debt does not go away. The banks are not going to be turned upside down and bankrupted because the debt is worthless. They will do anything and everything to try to keep the banks whole. Now, one thing we've not talked about, and we probably should, is the talk of resetting the price of gold higher in order to basically create more liquidity. All right, if you look at the gold that the U.S. says that we have and has not been audited since 1956, but let's assume that it is all there, it is all unencumbered, and it is all owned by the Treasury. That's 262 million ounces is the total in West Point, Fort Knox, etc. And that's priced on the books right now at $42 an ounce. So it's, from a balance sheet aspect, it's nothing.
Mm-hmm.
Now, if you revalue it to $3,400 gold, that's a bonanza, is what they're trying to tell us. It's a bonanza. Well, no, it's only $900 billion. What about the other $36 trillion that we owe? Now, this goes back to something I talked about as far back. I started doing the math on this, I think, in 2014, 2015, did the math 2 or 3 years ago. And every time I come up with a number, the comments section, people go nuts that, Holter's an idiot, he's retarded, doesn't know what he's talking about. But the number comes up to $125,000 an ounce. That's what's required, just north of $125,000 an ounce in order to cover the debt. And whether they go to that extreme or not, I don't know. I'm not inside. But I can tell you, if you own gold, you are going to have an official, call it a tailwind, because governments all over the world are wanting to revalue gold higher in order to create more liquidity and ease the debt situation. But understand, for years and years, forever up until now, the U.S. Treasury / Federal Reserve never wanted the price of gold to go higher because it's a direct competitor with the U.S. dollar. And if you look, just go back, 5 or 6 years, gold was $1,300 in 2019. It's more than doubled. And the price of gold more than doubling tells you that the value, the purchasing power of your dollar has dropped more than 50% in 6 years.
Bill Holter warns that the endgame is a central bank digital currency, much like China's social credit system. Holter mentions that after this, gold may be revalued, but a massive jump would disrupt all commodity markets. If the derivatives market collapses first, trade would revert to assets with intrinsic value, such as gold. Economic thought leaders advocating for monetary reform include proponents of the Austrian School of Economics, who generally favor hard money policies and view gold as an essential check against government spending excesses. Their arguments typically center on gold's historical role in enforcing fiscal discipline. On the ground, Holter notes retail gold and silver demand in North America is weak, while institutional demand is strong, draining COMEX and LBMA inventories. Holter warns that a failure to deliver would break confidence in the fiat system. LBMA silver inventories have decreased by 128 million ounces since November, and borrowing costs for silver rose to 7% in January. These factors suggest a tightening of the silver market in London, potentially due to increased industrial demand or a shift in investor preferences. Currently, Chinese gold and silver prices run about 10% above Western levels, driving Middle East and hastening a shift to a cash-and-carry market as confidence in paper trades erodes. Let's get back to the interview.
I can envision what they're talking about right now. Ultimately, what they want to do is they want to go to a central bank digital currency. Mm-hmm. That's the ultimate, because they want control over everyone, everything. And I think what they've done in China with the social credit system, that's ideal for a social credit system, because if you post something, you say something, you buy something that they don't like or don't want you to say or have or whatever, you get shut off. They'll just shut your account off and you're done unless you have other assets that are outside of the system. So the first reset, I think we're looking at it right now, is trying to hoodwink the public into, stable coin's going to work. I think there will be some pushback, a lot of pushback to the CBDC. And I think the reality that nothing changed from the dollar system to the stablecoin system, I think that reality is going to be seen immediately. So that reset may only last as short as 2 weeks, 2 months, what have you. So I think that'll be a short-term reset. I think then you'll see a revaluation of gold, and that will go along the lines of Mother Nature, but they can't let a full reset go or happen a Mother Nature reset where everything gets reset. Because what happens if you've got, 50, let's say they reset gold to $50,000. What does that do to copper? What does that do to silver for, the industrial, medicinal, solar, green energy? What does it do to those? What does it do to the price of rice? What does it do to the price of other assets? And there's going to be massive dislocations. And understand, we may not even get to any of this because if the derivatives market, or I should say when the derivatives market blows up, they are going to blow up. But if they blow up during this process, then Mother Nature takes over. And all of man's resets are done.
Null and void.
Right. Yeah, and then it becomes, then the system is completely burned down and it's got to reboot and start to re-energize. But at that point in time, it does not re-energize clearing trades with dollars. Trades will be cleared by something that has real value behind it. And obviously, the easiest thing is gold. And the other thing is, think about it this way: the average person is not, when people ask, at what point in time should I sell my gold or sell my silver?
What are you going to sell it for?
That's exactly it. What are you going to sell it for? Where are you going to put your money? And mass selling or movement away from gold or silver will not happen until there's a currency that people can trust. And in today's fiat world, people are savvy enough today to understand that, a fiat world doesn't work. Yeah, it's a two-tiered market. I can tell you firsthand, North American demand is way down. There's a ton of sellers. And the reason people are selling is because they're out of money. I'll bet you I've done 100 sales so far this year where people are cashing out. I've had, 4, 5, 6 saying buying real estate with it. But 85, 90% of the people that are selling say, I got to raise cash. I'm out of cash. Now, that's the retail side of it. And there's plenty of supply. Any type of product you want to buy, there's availability, and the premiums are as low as I've seen in 15 years. Now, the other market, the institutional market, that has been red hot and on fire. You can see it with COMEX deliveries. You can see it with LBMA inventories. The official inventories have collapsed. So with huge demand and collapsed inventories, it's only a matter of time before there is a failure to deliver. And if there is a failure, or when there's a failure to deliver, if we are still on a fiat system, everything burns down because a failure to deliver breaks confidence. And this entire episode is one huge con, as in confidence game. Confidence will break. But the paper in the West has been sold by financial institutions. They've naked shorted gold. They've naked shorted silver. That's suppressed the price. And the cash price is in China. Now, when those derivatives get blown up, you have the problem is you have balance sheets blowing up. You have big brokers, huge brokers, their balance sheets blowing up. And we get right back to where we were in 2008, where because it was a financial orgy, if your trading partner has been infected, people aren't going to trade with you because you're trading with an infected party. So confidence breaks, the chain breaks, and we will end up being a cash and carry market. When I say market, I'm not talking about just gold and silver. No. I think the derivatives in oil, in wheat, in grain, all the grains, the meats, all of those markets are going to end up being cash and carry markets because no one is going to trust the counterparty risk to the other side of the trade.
We are not predicting an imminent revaluation of U.S. gold reserves, nor would such a move resolve the underlying structural challenges facing American public finance. But the debate itself is significant. If revaluing gold is just a sign that fiat money has failed, what does that say about where the dollar and your savings are headed? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.